Hey guys, Mike here. Welcome to the 5-ish minute private family banking podcast. Last time I introduced the idea of a strategy called private family banking, and I mentioned towards the end of that video that at its base, this strategy is something that involves life insurance or a whole life insurance contract. I wanted to take the opportunity to pull the thread on that a little bit and talk about why a lot of high net worth individuals use whole life insurance policies in order as a place to store cash or capital that they have access to. I'll give you a hint. It's not the returns that they can achieve with the policy. I'll touch on that in the next video, but rather it's the combination of tax treatment, safety, control, liquidity, estate benefits, all of these things that the cash value coupled with a good death benefit can achieve. Okay, we're going to pick away at these over the next couple of episodes. If we need a part 2 or part 3, we're going to do it. I want to give these things the adequate amount of time that they need. So first, let's talk about the tax advantages of using the private family banking strategy. So there are tax advantages on the growth and the access of the cash inside of the policy. Okay, cash value inside of a life insurance policy is going to be growing tax deferred. So there's no annual tax drag on it, similar to you would have with a taxable brokerage account. And what this means is that when a policy is properly structured, in other words, it's kept underneath the limits for a modified endowment contract or MEC. They can access the cash through policy loans that are generally tax free. And they can do that while the policy continues to grow. Quick side note: what is a MEC? In short, a MEC is an overfunded life insurance contract. So what the IRS has done is they've created rules around the maximum amount of cash that somebody can have inside of a life insurance policy. And there are different factors that contribute to what that limit is, but generally it's a 7-pay rule. In other words, they create, based on what your premium is, a maximum amount of cash that you can put inside of that life insurance policy. Now, when a policyholder stays underneath that line, it's still considered a traditional life insurance policy and has all the benefits of tax-free growth and tax-free access to the cash through policy loans or withdrawals of your basis. Now, if it goes beyond that line, it becomes what's called a modified endowment contract. This means that while the cash inside of the policy is still tax deferred, any attempt to access that cash is made on a last in, first out basis. And that means that the gains inside the policy come out first and would be taxed as regular ordinary income. So what we do is we structure a policy so that it never goes beyond that threshold, right? And it never flips into becoming a modified endowment contract. Now, when we do that, we maintain those tax advantages of accessing the cash inside the policy on a tax-free basis, whether it's a policy loan or a withdrawal of their basis. And we'll talk about why somebody might do that down the road. But I just wanted to give you, kind of plant the seed that one of the reasons that people keep large amounts of cash inside these policies is because there are significant tax advantages relative to putting money into a brokerage account and then selling those assets when they need cash. They have access to cash on a tax-free basis. Hey, that's part 1. Next time when we meet, we'll look at the returns inside of the policy as well as the liquidity and some of the benefits of that. Please like and subscribe, share it with people that you know. We're trying to spread the word about this strategy and the benefits that it can have, not just to high net worth individuals, but to anybody who wants to take advantage of it. So until then, out.